Welcome everyone to Vested Interest. This is Shane back for another Stock Pick of the Day video. It is June 12th. Today we're going to take a look at one out of the consumer discretionary sector, Bath and Body Works. If you are new to the channel or if you would just like to help me out, go ahead and hit that thumbs up button down below if you find any value in the content. Make sure you are subscribed to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. Make sure you hit that notification bell so you're notified whenever we put out any new content. I do these Stock Pick of the Day videos Monday through Thursday. We take a look at a company that's pulled back on the day to see if it's presenting any value. I also do subscriber requests. So if you have a company like Bath and Body Works you'd like me to cover in the Stock Pick of the Day series, go ahead and drop it down in the comment section down below. And don't forget to comment. Let me know what you think of the videos. Let me know what you think of this stock. Is it in your portfolio? Is it one you're watching? Is it one you're selling? Or maybe you're avoiding altogether? Would really like to hear from you. Always enjoy responding to your comments. I do personally read and respond to the comments myself. And appreciate everyone who's taking the time to do that. And a special thank you to all the subscribers out there. Just hit 950 subscribers, getting very close to that 1,000 subscriber mark. So help me get there and then beyond. And again, really appreciate everyone who's taking the time to do that. It does help the channel grow. It does help to spread the videos. It does help with the YouTube algorithm the more that you do that. So thank you very much. Now, this is the Vested Interest Stock Screener. This is how I look at a company on a high level to see if I am interested in investing. If it meets the screener, 5 of 8, or if it's a bank or a insurance company, I use price to book, throw in price to book with 6 of 9, then it will go onto my watch list, and then I do more of a deep dive. That, again, that doesn't mean I'm buying. It just means it's going on my watch list. I'm interested. Then I do more of a deep dive into the financials, look at some other metrics like revenue growth, are the margins expanding, their EBITDA, and several others, their debt to equity ratios, assets over liabilities. There's other metrics that I look at in their balance sheet and income statements to see if I am really invested, but this is an initial screener to see if I'm interested in the company at all. There's thousands of stocks out there, and it's just a quick way to kind of gauge whether I want to do more of a deep dive or if I should just bypass the stock and go on to something else. This is also how I set up the video. So we will run through this screener on this company, and we will see if it meets 5 of 8 to make it on my watch list at the end of the video. Now, if you want to know more about this company, check them out at www.bathandbodyworks.com. That's www.bathandbodyworks. Let's try that again. www.bathandbodyworks.com. That is their homepage where I pulled this information from. www.bathandbodyworks.com. We make the world a brighter, happier place through the power of fragrance. At Bath & Body Works, we're bringing joy to millions of customers and making the world a brighter place through the power of fragrance, whether it's because of one of our fragrances sparks a fond memory or because you trust our commitment to safety and quality. We value the reason why you value us. Home of America's favorite fragrances, Bath & Body Works is a global leader in personal care and home fragrance that became an independent public company in August 2021. Our top-selling collections include fine fragrance mist, body lotion and body cream, 3-wick candles, home fragrance diffusers, and liquid hand soap. Powered by agility and innovation, our predominantly U.S.-based supply chain enables us to deliver quality on-trend luxuries at affordable prices. Bath & Body Works serves and delights customers however and wherever they want to shop. Welcoming in-store experience as our more than 1,850 company-operated Bath & Body Works locations in the U.S. and Canada, and our online storefront at bathandbodyworks.com, and our franchises located around the world. So they have a presence around the world, but primarily here in the United States. They might be somewhere that you went to buy, your girlfriend or your wife or your significant other, your aunt, whoever, some bath soaps, some fragrances, different lotions, all that sort of thing is what they're geared around. Again, maybe you've shopped in one of their stores. I know they were pretty popular back in the day when malls were still popular. I know those aren't as cool anymore, but back in our day, it was one of the main stores in every mall that you would go to, Bath & Body Works, along with some other ones, Foot Locker and a couple other ones you could count on definitely being in any mall you stopped at. Again, I haven't been to a mall in years, and I don't think they're as popular, but Bath & Body Works is still around. They have some standalone stores as well, so they may be somewhere where you have been and shopped in. Let me know in the comment section down below if you've ever been in a Bath & Body Works, or if you get your lotion or your soaps or candles or something like that. I'd love to hear from you. Now, the reason we were taking a look at them, down 2.24% on the day. We are talking about Bath & Body Works, ticker BBWI, again out of the consumer discretionary sector. 52-week range as low as $27.30, as high as $52.99. They are a little bit closer to their 52-week high than their 52-week low, and they are not within 15% of their 52-week low, so that would not be a check mark there. Now, their market cap of $9.958 billion makes them a small cap company, a beta of 1.89. So this company is much more volatile than the overall market, almost twice as volatile. You can see that volatility. Big drop there, recovered a bit, dropped again, recover, drop, and then sell off throughout the day starting about 10 o'clock. Price to earnings PE ratio is low at $11.53, but is it low for a reason, right? And this is where I'd want it even lower than this. You want to try to get this one as close to its 52-week low as possible. Again, I think it's maybe a little overvalued. It's recovered a little bit from some recent lows, but that's not a bad PE for a company like this, though single digits would be better. EPS, earnings per share, sitting at $3.79. Earnings date coming up in August 21st through the 26th, sometime in that time frame. Forward dividend is 80 cents paid out on the year. They are quarterly payers, so divide by 4, though we will see that here in a little bit. Starting dividend yield of 1.75%. That's pretty close to what the overall market is. Ex-dividend date, June 7th. So we just passed their ex-dividend date, so you would not get this June 21st payout. You would have to wait a couple months for their next dividend payout. 1-year target estimate, at least according to Yahoo Finance, where I pull this information from, $52.18. So they see some upside as far as stock price appreciation. And I'm not affiliated with Yahoo Finance, just one of the sources I go to for information. Now we're going to check out dividend yield theory. To do that, we look at 5-year dividend yield average. Their 5-year dividend yield average at 5.47%. We compare it to its current forward dividend, 1.75%. Over here, 1.75%. Their current, it's the same number. And since it is lower and much lower, that speaks to overvaluation, at least according to dividend yield theory. So I'm wondering if they recently had a dividend cut, because that's a very high 5-year dividend yield average of 5.47% for it to be so low. Or they were just selling extremely low over the last 5 years. But I would assume that they've had a dividend cut here recently, and that is why their 5-year average is so much higher than their current dividend yield. Payout ratio is low at 20.67%, so that's good. Now we're going to take a look at free cash flow. We want growing free cash flow over time, because typically if a company has growing free cash flow, they have growing dividends to go along with it. Going back to 2021, you can see here at $1.8 billion. 2022 down to $1.2 billion. 2023 down again to $816 million. And continuing that trend, going down to 656. So they are going in the wrong direction, though I will say in 2022, in 2023, as well as 2024, they did repurchase some shares. Not as many so far in 2024 here as they did in 2022 or 2023. And I'd have to do the math, but this may well account for the drop in free cash flow from 2021 to 2022. I don't know that it really accounts for all of it, because they're not only down in the free cash flow, but they're also down in repurchase of capital stocks in 2023. Still a big chunk there at $1.3 billion, and not so much so far in 2024. Obviously, 2024 they're not done with yet, so they very well could be. But I am not going to give them growing free cash flow here. I'm going to say 2023 was down a little bit compared to 2021 and 2022. Now we're going to jump over to stockanalysis.com. This is another source that I like to go to for information. I am not affiliated with stockanalysis.com, just another source, and I always recommend more than one source so you can make sure the information you're getting is accurate and up to date. 2, if not 3 sources, again, so you can back check the information you're getting is accurate. Now they have 15 stock analysts that have taken a look at this. They call it a consensus buy, though it is right on the edge of a buy and a hold. So if you were to go to stockanalysis.com, you could click on each one of these and see how many might call it a strong sell, a hold, a buy, or a strong buy. Again, looks like it's just leaning ever so slightly to a buy according to those 15 analysts. Now they do have a low estimate of $30, which would be a 31.35% decrease from where it currently sits. Average estimate of 46.73, which would be a 6.93% increase from where it currently sits. And if it happened to hit their high of $56, that would be a 28.15% increase. All the while, you could collect that 1.6 or 7% dividend yield that they currently sit at. Obviously, if you got it lower, that would be better, but that's where they sit currently. Now we're going to jump over and look at statistics. I like to look at return on equity and return on invested capital. I like 10% or better here. And this tells you how well a company is investing its capital back into itself, and that's making acquisitions, that's building out new stores, remodeling, that's paying down debt, That's paying dividends, repurchase of shares, all the things that they do with their cash. Return on equity here, negative 46.60. Not good. That is not a good number. We don't like that at all. Return on invested capital, 29.41%. That's very good. So a mixed bag here. I would not give them a check for that. EPS growth, I like 5% estimated over the next 5 years or better. They're at 8.42, so that's a check there. Revenue forecasted growth at 3.07%. Now, it's not one of my initial screeners, but it is one I look at when I do more of a deep dive. I look at their overall revenue growth over the last 5 years. And I don't really pay attention to the forecasts, but it's nice to see that they are forecasting revenue growth here. Now we're going to take a look at the dividend history. Again, they are a quarterly payer. Payout ratio low, 20.73%. Again, no dividend growth here. So that's not good. We want dividend growth over time. And I didn't go back past 2021, but I'm assuming that they cut the dividend back here somewhere because that's the last time we saw dividend growth. 2021, they were at 15 cents, and then they raised it up in February 2022 to 20 cents, but they have not raised it since that raise in 2022. Buyback yield of 1.69%, shareholder yield of 3.47%, so that's good. Their buybacks are in the positive, so they're doing a good job buying back their shares, and their shareholder yield is positive. So this is a mixed bag on this one, to be totally honest with you. Let's see what the screener has to say. Oh, one last thing. Their payout is on the March, June, September, December timeframe, which most companies are, so no surprise there. Now let's look through the screener. Again, we started with understanding the business. That's why you want to go to their homepage first, see what they do, how do they make their money, check there. Growing free cash flow, no, I am not giving them a check there. Growing dividend, no, they have not grown their dividend since 2022. Dividend payout ratio 75%. They are under 75%. They're only in 20%. Low payout ratio on this one. Check valuation according to dividend yield theory. Nope, not good. They were at 5% here over the last 5 years, and then way down into the 1.6 or 1.7%, somewhere in there currently. So buy below cost basis or 15% of a 52-week low. It is not. It needs to be right around $33.39 or lower to be within 15% of its 52-week. I would say under $33 on this one, really. Under 30 would be preferable. Return on invested capital or return on equity equal to or greater than 10%. No check there. Earnings per share growth was estimated at 5% or better. So they do get a check there. So 1, 2, 3, they would not make it on my watch list. That doesn't mean they can't make it onto yours. And if you want to tweak this screener, to add some other ones that you like better than the ones I have, that's fine. You don't have to blindly copy anyone, and you shouldn't be blindly copying anyone on YouTube. You are your own person. You have your own investing timeline. You should have your own investing criteria and be setting that up for yourself. Never blindly follow someone on YouTube and do what they do. Make sure you are doing your own investing. And if you don't want to do this type of deep dive or even a high level dive into companies, you should not be investing in individual companies, and you should stick to ETFs. My recommendation would be the same thing that Warren Buffett would recommend to you on S&P 500 ETF or index funds, something like VOO, VOO, or the SPY, SPY. Both of those are actually in the Berkshire Hathaway portfolio. So he not only recommends them, he also puts his money where his mouth is. That's what he has bought in the past. So again, this would not make it on my watch list. Let me know what you think in the comment section down below. And as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. Hit that notification bell so you're notified whenever we put out any new content. And drop a comment down below. Again, let me know what you think. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Hope you have a great week, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk and handles money to never invest any amount. It comes leading. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek lead advice, counselor, certified financial advisor.